Assalamualaikum. This is on chapter 7, using consumer loans, the role of planned borrowing. So the learning objective of today is to understand the various consumer loans, to calculate the cost of a consumer loan, to pick up appropriate source for your loan, and also control your debt. So firstly, consumer loans are a formal contract detailing how much you borrowed and when and how are you going to pay it back. It is used for a bigger purchases, and debt and borrowing can get out of control. You have a variety of choices. You have single payment loans, you have variety rate installment loans, you have unsecured fixed rate loans, and you have secured loans. For the first decision, single payment versus installment loans. Single payment, or a balloon loan, paid back in a single lump sum payment with interest at maturity. So bridge or interim loans versus short-term loans. No, it's not versus, it's short-term loans. Installment loans are repayments of both principal and interest at various interval. So this is about loan amortization, which each payment and the interest portion covered decreases and principal portion covered increases. So firstly, in any amortization loans, the first few years you paid the interest in a larger portion, in a higher percentage. As the loan reaches towards its maturity, or as it reaches its terms, you are paying the next terms is you're paying the principal amount. Secured loan versus unsecured loan. Secured loans is loans that are guaranteed by an assets as a collateral, which typically lowers the rate of loan. Unsecured loans are not guaranteed by an asset or a collateral. Third is variable rate versus fixed rate loans. Fixed rate interest rate loan stays fixed for the entire duration of the loan and is not tied up to the market interest rates. Variable rates or adjustable interest rates are interest rates of the loans that varies based on the market interest rates. Prime rate, the interest rates that bank charges to their most credit-worthy or prime customer. Convertible loans are variable rate loans that can be converted into a fixed rate loan. The fourth decision is the loan's maturity, shorter versus long-term loan. Shorter term loans means lower interest rates and larger monthly payments. Longer term loans means smaller monthly payments but higher interest rates. So understanding the term of a loan contract, the loan contract has many terms. Okay, these are a few of the terms. So security agreement is an agreement that identify whether the lender or borrower retain control over the item being purchased. It states the payment schedule and the right of both lender and borrower in the case of defaults are outlined in the notes. That is security agreement. Note are formal documents outlines the legal obligation of both lender and borrower. Defaults is actually an act of failure of a borrower to make a scheduled interest or principal payment, meaning to say, in other words, they don't pay on time. Acceleration clause is a loan requirement stating that if a borrower misses one payment, the entire loans come due immediately, meaning you have to pay the entire loans. If you can't pay off the entire loans, the collateral will be repossessed and sold to pay off the balance. So deficiency payment clause, it states that if a person default on a secured loan, all secured asset will be repossessed during the sale of assets which is not a collateral, and the borrower will also be billed for a different, meaning to say, let's say the collateral that was put in for the asset has been sold and still not enough to cover the loan, other asset will also be repossessed to pay off the claim, and the borrower will also be billed for all other fees, for example administration fee, processing fee, advertisement fee, court fee, and so on. Recourse clause is actually a clause in a loan contract defining what actions a lender can take to claim money from a borrower in the case of defaults. Okay, these are some of terms of loans. So this is actually an installment purchase contract, how it looks like. Basically in Malaysia also it looks a bit similar but different from bank to bank, but basically this states here the itemized amount finance. The contract shows any fees or insurance charges that are added to the unpaid balance in determining the total amount to be financed. So it's all here. So the number of months, total amount you pay, this does not include your down payment, and everything is here. So a Malaysian has stated everything, how many months that you need to pay, and so on and so forth. Yeah. So finance charges, how much, for the term of how much, and so on. Okay, we also have a special type of consumer loans. That is home equity loans or second mortgage. This is a secured loan using equity in homes as collateral. Meaning to say, you have your home loan, and after several years you wanted to have your second mortgage loan, which you can call in Malaysia what we call refinancing, and your house become the collateral of your second loan. Advantage: interest is tax deductible, lower interest than other customers' loan. Disadvantage is that puts your home at risk and limit future financing flexibility. So in the US, they have student loans. This is low federally subsidized interest based on financial needs. So in Malaysia, we do not have student loans. We have PTPTN with a very minimal interest rates, and students are supposed to pay. There is a scheduled payment after you work. So figure this one's percentage of student at a 4-year college who borrows. Yeah, so there are higher percentage of student who borrowed compared to student who does not borrow. And then we have also automobile loans. This loan secured by an auto, duration is for 24, 36, 48 months, even 5 to 6 years. In Malaysia is up to 9 years. Low cost autos loans rate used to push slow selling vehicles and older models. Repossession if defaults on loans. They will actually repossess your car, tarik kereta tu, if you don't pay on the loans. Okay, cost and early payment of consumer loan. APR is annual percentage rate. Simply is a simple percentage cost of finance charges over the life of the loan and is on annual basis. The Truth in Lending Act requires all customer loans agreements to disclose APR in a bold print. So you should be given the understanding and also the knowledge of what is your annual percentage rate. So cost of single payments loan, there is a how to calculate. Later we go to the next slide and see how they calculate cost of a single payment loans. Loan disclosure statements give APR and finance charges of the loan. Simple interest method is that principal times interest rate times time, and we also have the discounting method. Yeah. So here is a type of loan disclosure statements. You were given this if you were to actually acquire a loan. Payday loan, this is a dangerous kind of loans in the single payment, 100 to 500 loans until the next payday. Posted dated checks with fee and principal left with payday lenders. It is due 1 or 2 weeks. Annualized interest rate up to 400%. This is very much similar like you are drawing from your credit card. You are actually taking loans out of your credit card. So the interest charges is daily interest charges, and it's expensive, and annualized interest rate up to 400%. So some facts on payday loans. 99% of payday loans go to the repeat borrowers. The average payday borrowers is flipped 8 times by a single lender. Okay, this one you can read. Okay, Cost of an installment loans. Repayment of both interest and principal occurs at regular intervals. Payment levels are set so loan expires at the present date. Either they use either simple interest or add-on method to determine what payment will be. So this is a monthly installment loan table. 1,000 loan with interest payment compounded monthly. So you can see here, this is the loan. Determine the monthly payment for a 12 months loan, 14% installment loan for 5,000. Looking at the intersection between 14% and the row of 12-month column, we find that the monthly payment on a similar 1,000 installment loan would be $89.79. To determine the monthly payment on 5,000 loan, we need to multiply 89.75 by 5 because this loan is 5,000 rather than 1,000. So that is actually your monthly payment for 5,000 at 14% for a year. So this is 12 months, you 5,000 for 14% yet. So starting balance 5,000, total monthly payment is 44.94. Interest on the monthly payment is actually 58.33. The principal goes 390.61. Then you get a total ending balance. Principal, this one minus this one, you get 4609.39. It goes up until the 12 months. So the total, if you borrowed 5,000, you paid actually after 12 months is 5387.28. So the interest itself on the 5,000 loan is 387.22. Yeah. So how we calculate APR? Okay, you are considering a 12 months add-on loans for 5,000 at 14% with a total finance charges of 700. The loan has 12-month payment of 475. What is the loan's APR? This is to find out how much is the annual percentage rate. Yeah. So you have 12 months. APR equals to number of payments in year times with 95. N is number of payments over the life of the loan plus 9 times with F is the total finance charges divided by 12 and number of payment over the life of loan times N plus 1 times with 4. P is the loan principal times with the finance charges. So 12 is the month of number of payments in a year times with 95. That is the N. That is for 95 times 1. Yeah, that is 1 year times 12. Sorry, 95 times 12. N is 12 months plus 9 times 700. 12 times N is 12 times 12 plus 1 times with 4 times 5,000 plus 700 is the finance charges. So sum it up, your APR for this 12 months is 24.91. 14% add-on loan is actually a 24.91%, the annual percentage rate. So if an installment loan is repaid early, determine the amount of principal still owed. The common method for add-on loan is rule of 78 or sum of the year's digit. The rule of 78 determines what proportion of each payment goes towards principal. Prepayment, and you also need to pay prepayment penalty. For example, you have a 12 months add-on loan at 5,000 at 14%. You have been paying for 475 a month for the past 6 months. Would you like to pay off this loan? How much do you still owe? Sum of digit is N divided by 2 times with N plus 1. 12 divided by 2 times with 12 plus 1 is 78. That is the rule of 78. So the sum remaining months, in the case you will sum the number of by the remaining months. Okay, this is on for you have paid for 6 months, you remain of the 6 months, 5 months, 4 months, 3 months, 2 months, 1 month, that is 21 portion of interest avoided is 21 divided by 78. Then you determine the dollar interest charge.